45% denied. That's the SBA loan rejection rate right now. And if you're one of those business owners who just got that call or that letter, this episode is your next move.
It's a brutal reality check for a lot of people.
Yeah, we're going to break down exactly what to do after a bank says no, because a denial is not a dead end.
It really isn't, even though it certainly feels like one in the moment.
Oh, absolutely. Look, getting that rejection letter feels incredibly stressful and, deeply personal. You pour your life into your business, you submit all the paperwork, and a sterile algorithm just kicks back a no.
And the worst part is most people just suffer in silence when that happens.
Right? They think it's just them. They're completely unaware that nearly half of all applicants are facing this exact same hurdle right now in 2026.
It's basically a silent epidemic in the small business world right now. I mean, if we look at the latest Federal Reserve Small Business Credit Survey, the contrast between ambition and capital access is just staggering.
Yeah, the optimism is still there, right?
Exactly. You have this overwhelming wave of entrepreneurial optimism. Like 94% of small businesses are projecting growth this year. They have the demand, they have the vision, they want to expand.
But the money just isn't flowing.
No, it's not. Simultaneously, we are experiencing a massive institutional credit contraction.
So traditional banks are just pulling back and locking the vault doors.
Pretty much. We've seen stricter lending criteria from traditional institutions for, gosh, over 3 years straight now. The regulatory pressure and the shifting interest rate environment have made banks incredibly risk-averse.
Which forces everyone to look elsewhere.
Right. It's gotten so restrictive that 74% of small businesses are now bypassing traditional banks entirely when they need capital.
Wow, 74%?
Yeah, they aren't even walking into the local branch anymore to ask for an application.
Which makes sense. So the mission for our deep dive today is to figure out the specific strategy to pivot. We're going to take your sources, parse through the data, and build a concrete path forward from a denial to actually getting your business funded.
It's all about finding the right leverage.
Exactly. But to fix a rejection, you first have to understand the specific point of failure. Because reading through these industry reports, it's really clear that a denial today is rarely just about having a bad credit score anymore.
No, not at all. You can have a pristine 720 FICO and still get the door slammed in your face.
Okay, let's unpack this. If a business is profitable on paper, how on earth are they getting denied? It's kind of like passing a basic physical, but failing the stress test because your heart rate spikes the moment they put you on the treadmill.
That's a great way to put it. The bank isn't looking at your health sitting still. They're looking at how you handle the weight of new debt in motion.
Right.
And the number one metric they use for that stress test, the one that trips up so many otherwise profitable businesses, is the DSCR.
The debt service coverage ratio.
Exactly. Business owners often look at their net income and just assume they're a lock for approval. They see black ink on the profit and loss statement and think, hey, I'm making money, I qualify.
But profitability does not equal cash flow.
Precisely. A business can show a massive profit on paper, but if all that cash is tied up in slow-moving inventory or unpaid accounts receivable, the bank sees a massive liquidity risk. Lenders in 2026 want a DSCR of 1.25x.
So let's break down the math on that for a second. A 1.25x ratio basically means you need to generate $1.25 of free available cash flow for every $1 of total debt obligations you have.
Right, it's about having a buffer.
Yeah. So if your business brings in $100,000 in available cash, but your annual loan payments total $90,000, your DSCR is only 1.1. You have a $10,000 cushion, but you still get denied.
Because if your ratio is 1.1 or, even worse, 1.0, you're basically just breaking even on your debt. You have virtually zero margin for error.
One bad month and you're underwater.
Exactly. If inflation drives up your raw material costs next month, or your commercial lease goes up, or you just have to increase payroll to retain staff, you default. If you don't hit that 1.25x threshold, traditional banks just will not take the risk.
Which kind of exposes the second massive hurdle the data calls the stacking trap, right?
Oh, the stacking trap is brutal.
Yeah, the research shows that 41% of denied firms cite high existing debt as the primary cause of their rejection.
And it happens so easily. Mechanically, what happens is a business experiences a brief cash crunch. They take out a fast, short-term advance just to cover payroll or something.
Right.
Then, a few months later, Things get tight again, and they take out another one just to cover the daily payments of the first advance.
Oh man, it's like paying off a credit card with another credit card.
Exactly like that.
Yeah.
Suddenly, they have multiple daily or weekly micropayments stacked on top of each other, constantly draining the operating account. Their DSCR is just completely destroyed.
And then when they finally go to a traditional bank for a long-term, lower interest loan to consolidate it all, the bank looks at the debt load, sees a DSCR well below 1.0, and just hits decline.
Yep. But there is also a highly mechanical reason for denial that catches founders completely off guard. It's the silent killer.
The UCC filings.
Yes. We are seeing a huge wave of businesses getting denied because of unresolved UCC filings.
Yay.
So, when you take out any kind of business loan or advance, the lender typically files a Uniform Commercial Code 1, a UCC-1, with your state's Secretary of State.
Which is basically a public notice staking a legal claim on your business assets as collateral for that money.
Right. It's totally standard. The catch is what happens mechanically when you actually finish paying off that debt.
Which is where things get messy.
Exactly. When the debt is cleared, the lender is supposed to file a UCC-3 termination statement. That document officially releases their legal claim on your assets.
Okay, makes sense.
But many alternative lenders simply forget to file it. Or their legacy automated systems just fail to trigger the release.
Wait, really? They just leave the lien on your business?
All the time. So a business owner walks into a traditional bank, fully debt-free, ready to fund an expansion. The bank pulls the public records, sees 5 active UCC liens for the past 3 years, assumes the business's assets are leveraged to the gills with other creditors, and denies the application on the spot.
Wow. So looking at the data, the immediate triage after a denial isn't frantically applying for another loan, it's actually conducting a technical audit of your own business profile.
Absolutely. You have to play defense first.
Right. So if you get denied, you have to exercise your rights under the Equal Credit Opportunity Act and request the advert action notice.
Yes, this is crucial.
Because the lender is legally required to send you a document detailing the exact technical reason they said no. But you only have a 60-day window from the denial to ask for it.
And once you have that notice, you go to your state's public registry website, search your business name for stray UCC-1 filings, and formally demand those termination statements from your old lenders.
You also need to clean up excessive owner draws that might be dragging down your cash flow on paper, right?
Definitely. And realistically, you need to prepare to wait 4 to 6 months to let the credit bureau updates kick in and to show a sustained upward trend in revenue before you go back to a traditional bank.
But waiting 4 to 6 months to fix a credit profile is, it's great for long-term planning, but businesses need capital now to operate.
Right. The 4 to 6 month remediation plan basically operates in a theoretical vacuum. It assumes the business can just hit the pause button.
Which you can't. You have payroll clearing on Friday. You have inventory that needs to be ordered today for the holiday rush. If you applied to the wrong lender, how do you find the right one without exhausting yourself?
Well, applying to the wrong bank happens a lot. They go to their local community bank, completely unaware that this specific bank's internal underwriting policy strictly forbids lending to restaurants or long-haul trucking companies due to sector risk.
So they never stood a chance, regardless of their financials.
Right. So the challenge becomes how to find the right lender without destroying your credit score in the process. Because every time a bank does a hard pull on your credit to evaluate an application, it drops your score.
Yeah, if you apply to 5 different banks in a panic over the course of a week, you are actively sabotaging your own credit profile. It feels like blindly knocking on doors in a massive apartment building, hoping the person who answers happens to be a banker.
That's exactly what it is.
Which is why this deep dive is produced by BusinessLoan.Directory. They're a free online platform that connects business owners to over 75 different lenders through a single 2-minute pre-qualification form.
It's a huge time saver.
Exactly. This is how you compare multiple lenders after a denial instead of going door to door. You enter your basic revenue and time in business metrics once, and their system matches you with the institutions that are actively looking to fund your specific industry and financial profile.
And the best part is the soft pull.
Right. And here's where it gets really interesting for your credit profile. Pre-qualifying through a marketplace like this doesn't hurt your credit score.
Yeah, that's huge.
You can actually see what the open market will offer you without doing any further damage to your FICO score.
And the underlying mechanism powering that kind of platform is what we call waterfall lending.
Tell me about that.
So in the traditional analog model, you apply to Bank A. Bank A has strict prime borrower requirements, Let's say they mandate a 700 credit score. You have a 680, they deny you, and you are back to square one, researching Bank B, preparing a whole new application package.
Exhausting.
But in a waterfall system, your application cascades automatically. If the prime lender's underwriting API returns a no, the software instantly routes your profile to a near prime lender whose threshold might be, say, 650.
Oh, nice.
And if they pass, the application drops down the waterfall to a subprime or alternative lender who focuses purely on your cash flow rather than your credit score.
So you bypass the entire manual application cycle. In 2026, technology basically does the heavy lifting to find the capital where it actually lives.
Exactly. It evaluates your profile against dozens of underwriting algorithms simultaneously in a matter of seconds.
Okay, so now that we know how to search the market, we need to understand the actual alternative products the market will offer you after a bank denial.
Because once you step outside the traditional bank sphere into that alternative market, the financial products change fundamentally. The entire concept of a traditional loan starts to blur.
Yeah, let's look at those fast capital alternatives, specifically merchant cash advances or MCAs. Now, I have to play devil's advocate here.
I knew this was coming.
Wait, aren't MCAs essentially a debt trap? I mean, I've heard horror stories of businesses getting choked out by relentless daily bank withdrawals.
Look, you're not wrong to ask that.
Yeah.
It's a highly polarizing product. Legally speaking, an MCA is not a loan. It is the purchase of your future receivables at a discount.
Okay.
And honestly, yes, they are the most expensive option on the market because the provider is pricing in massive risk. Instead of a traditional annual interest rate, they use a factor rate, typically ranging between 1.15 and 1.45.
Right. Let's break that math down so the mechanics are crystal clear for everyone. If you receive a $100,000 advance at a 1.3 factor rate, you owe $130,000. It sounds like a 30% interest rate, but that's a dangerous misconception.
Very dangerous. The real issue lies in the velocity of repayment. You are paying that $130,000 back incredibly fast, often within a 3 to 9 month window, through automated daily or weekly withdrawals directly from your operating account.
So it drains you fast.
Yeah, and because the term is so compressed, if you translate that flat factor fee into an annualized percentage rate, an APR, it often ranges from 40% to well over 100%.
Wow.
If a business uses an MCA just to cover operating losses or keep the lights on during a slow season, the daily cash drain accelerates their failure.
But there is a flip side, right? Faster funding usually costs more, but sometimes the cost of not having the capital is higher.
Exactly. MCAs can fund in 24 to 48 hours with almost no credit requirements based purely on the volume of your recent bank deposits. But it only makes mathematical sense if the return on investment outpaces the cost of the capital.
Give me an example of that.
Think about a retail scenario. A supplier offers you a 15% discount on a massive bulk order of inventory, but you have to wire them cash by tomorrow morning.
Right.
Your historical data proves you can sell that inventory at a 40% markup within 60 days. The actual dollar cost of not having that capital to buy the inventory is much higher than the fee you'll pay on the MCA.
So it's a tool, not a trap, if used right.
Exactly. It's a scalpel, not a Band-Aid. It's a tool for high-confidence, near-term returns.
Okay, but if the daily fixed dollar drain of an MCA is what causes that debt trap for slower businesses, what else is out there?
Well, the logical evolution is a financial product that breathes with the business. If revenue drops, the payment obligation has to drop. That's the core philosophy behind revenue-based financing, or RBF.
Right, RBF. It seems tailor-made for businesses that have predictable monthly recurring revenue, like a sauce company or a marketing agency on retainer or a steady e-commerce brand.
Yep, it's perfect for them.
But how does the underwriting actually work without relying on FICO scores or heavy asset collateral?
RBF relies heavily on live API integrations. The lender connects directly to your payment processor like Stripe or your accounting software like QuickBooks. They evaluate your real-time revenue data as it flows into your accounts.
Oh, that's smart.
Yeah, and instead of taking a fixed daily dollar amount regardless of your sales, RBF takes a set percentage of your monthly gross revenue, usually between 2% and 10%, until the total repayment cap is reached. That cap is generally 1.3x to 2.0x of the original advance.
So what does this all mean? It means the lender's risk aligns perfectly with your actual real-time cash flow.
Exactly.
If you have a phenomenal month and bring in double your usual revenue, the 5% they take is a larger dollar amount and you pay off the advance faster.
And on the flip side, if you hit a seasonal slump or a major client pauses their contract, your required payment automatically drops because 5% of a smaller number is a smaller payment.
You aren't defaulting. You aren't scrambling to cover a rigid bank loan payment while sales are down.
Right, the timeline just extends organically. It completely removes the existential anxiety of the fixed monthly payment. You give up a slice of the pie, but the size of the slice shrinks if the pie shrinks.
It allows founders to access growth capital without giving up equity to venture capitalists and without meeting the rigid DSCR requirements of traditional banks.
Absolutely.
But leveraging future sales, which is the core mechanism of both MCAs and RBF, isn't the only way to generate liquidity. What if you could unlock the value of things you already possess right now?
You mean like invoice factoring?
Exactly. It's like paying a small toll to use the financial fast lane instead of sitting in 90-day traffic on the highway.
That's a great analogy. Invoice factoring solves a specific structural problem in B2B industries, like manufacturing, commercial logistics, or enterprise consulting.
Where you're always waiting to get paid.
Right. You do the work, you deliver the product, and then you issue an invoice with net 30, net 60, or even net 90 payment terms. You are effectively acting as a free, zero-interest bank for your clients, letting them hold on to their cash while your operating capital is trapped in accounts receivable.
And your employees still expect their paychecks on Friday. I mean, you can't tell your warehouse staff to wait 90 days for their wages because a corporate client is taking their time.
Exactly. So instead of waiting, you sell that unpaid invoice to a factoring company. They immediately advance you 80% to 95% of the invoice value, usually within 24 hours.
Wow, that fast.
Yeah. Then, when your customer eventually pays the invoice 60 or 90 days later, the factoring company takes their fee, which is typically just 1% to 5% of the total invoice value, and sends you the remaining reserve.
And here is the critical takeaway for someone who just got a bank denial letter. The approval for invoice factoring is based on your customer's credit, not yours.
This is the best part.
Right. If you operate a small commercial trucking company and your credit score dropped to 550 because of a dispute, but you are hauling freight for Walmart or Amazon, the factoring company doesn't care about your FICO score.
Not at all. They look at the invoice, they see Walmart is the one paying, and they know Walmart is good for the money.
It is an incredible workaround to get immediate cash flow when your personal credit profile is radioactive to a traditional bank.
Because you are liquidating a present asset, not taking on future debt. It doesn't even show up as a liability on your balance sheet, which protects your debt-to-income ratios.
That's amazing.
And if we look at equipment financing, it operates on a very similar principle of utilizing inherent value, but for physical depreciating assets rather than paper invoices.
Right, like if you need a new commercial walk-in freezer for your restaurant or a new excavator for your construction firm, a traditional unsecured business loan isn't your only option.
Exactly. With equipment financing, the machinery itself acts as the collateral for the loan.
So it secures itself.
Yeah, because the lender has a hard asset they can repossess and liquidate on the secondary market if you default, their risk is substantially lower. Consequently, they are far more willing to approve businesses with credit scores in the 500s or low 600s.
The data shows the interest rates on equipment financing can range from 5.5% up to nearly 29% depending on your credit profile and your time in business, but it bypasses those strict unsecured cash flow requirements.
Because the logic is straightforward. You need the equipment to generate the revenue, and the equipment essentially pays for itself through increased operational capacity.
All these options, MCAs, RBF, factoring, equipment financing,
They all represent a fundamental shift from historical evaluation to real-time, asset-based, or cash flow-based evaluation. Traditional banks look backward at tax returns from 2 years ago to determine if you are worthy of capital today. Alternative lenders look at the actual data flowing through your business right now.
It really is a different world. Let's synthesize this journey. We started with a gut punch. 45% of SBA loans are being denied right now. It feels like hitting a brick wall.
It really does.
But what we've unpacked today is that a denial just means you've been forced out of the traditional slow lane banking system and into a dynamic, highly responsive alternative market.
The options in that market are vast, but they require careful navigation.
Definitely.
The cost of capital is generally higher, so the precision of your financial strategy has to be sharper. You have to know the exact profit margins of your business before taking an advance. Or you risk accelerating a failure rather than funding a success.
And that is why we have to give you this final, genuine piece of advice. Look, if you got denied, the worst thing you can do is sit on it and let your cash flow dry up, or worse, panic sign with the very first alternative lender who sends you a glossy email saying yes.
Please don't do that.
Go to BusinessLoan.Directory, take 2 minutes to pre-qualify, and see what the actual market says you qualify for. That's the smart play. Let the waterfall lending technology do the work for you, compare your options side by side, and make an informed decision without hurting your credit score.
If alternative lenders are already using AI to evaluate your daily QuickBooks data and Stripe transactions to fund you in 24 hours, it raises a larger question.
What's that?
If we connect this to the bigger picture, the 2026 credit market has permanently bifurcated. Traditional banks are relying on static, historical FICO scores, while alternative lenders are underwriting your real-time daily cash flow using AI.
The data gap is massive.
Exactly. The businesses that will ultimately dominate their industries aren't the ones with the perfect credit scores. They are the ones who learn how to weaponize their live data to access capital when everyone else is taking no for an answer.
A completely reshaped financial system. So the next time you look at that 45% denial rate, remember that letter isn't telling you to stop. It's just telling you to change lanes. Keep building, keep growing, and we'll see you on the next deep dive.